what you have to understand right at the very beginning of anything is not every idea that Patrick wakes up having is an options trade.
Yeah.
Which gets to the heart of what separates Patrick from Steve Cohen. You know who Steve Cohen is?
Yeah.
Okay.
Oh, yeah.
What separates Patrick from Steve Cohen? Two questions. That's it. Okay? I've dealt with these guys for 20 years, 25 years. What separates you from Steve Cohen? Two questions. When do I use options? When, which you just asked, when do I use them? And then the second one is, which one do I choose? There's so many, okay? Two simple questions. All of options education comes down to two simple questions. And I'm gonna tell you right now that you can go spend 100 hours learning wherever you wanna learn. Spend 15,000, 30,000, whatever you wanna spend to go learn. And you're gonna come back to me and you're gonna ask me the same two questions because you can't get an answer.
Yeah.
Okay? That's incredible. I'm going to tell you, over the day, I'm going to tell you incredible statements. That's incredible. I just told you that you can go spend hundreds of hours learning, and at the end of the day, you're going to come back, and you're not going to be able to answer those two questions. That's an incredible statement. Okay? So the question is, and I'm not going to answer it right now right in the very beginning, but that's the number one question.
Yeah.
And the second question behind that is, once you say, you know what, I think Apple's going up. And I'm going to say, how far do you think it's going up? I think it's trading 235. I think it's going to go to 245 by, earnings. Great. Now the question is, should I use options or should I use stock? Now the answer has to do with risk reward.
Yeah. I guess
okay.
At the end of the day, like you said, you're looking for leverage, for opportunity. You're basically cost of opportunity.
Yeah.
With the options,
you're looking for leverage. You're looking for opportunity. You're looking to see whether or not I can make more money using options than with stock.
Yeah.
But not only that, but starting to weigh the possibilities, right? If Apple going up or down is 50-50, Apple going from 230 to 235 to 245 is not 50-50.
Yeah.
That's a smaller percentage. So you got to start weighing what probability does Apple have of going higher, and then you got to weigh the price you're willing to pay for that option if it gets there.
Yeah.
And then you got to weigh how much you're going to make if it does get there between the two. And you got to weigh those. You got to balance those out, right? That risk-reward analysis, that's what Options Geek's about. I built Options Geek to actually help you answer that question, okay? Because that's the number one question. And then once you realize that, you know what, this is an options play, I should be looking at options, then the next question is, I got to get you on the board. I got to get you to look. I got to get you to look at the board because now there's 50 different options.
Yeah.
There's puts, there's calls, all this. You got to look and you got to say, this is the right one. And you can't just say it's the right one because this, and I got a feeling, and you got to have a real understanding of why that's the right one. So my question, when I sat at Bank of America and any one of the big guys came up and said, I want to buy 20,000 of these options. And I said, okay. In my head, the only thing I was thinking about was, why that one?
Yeah.
Why did he pick that one? Why not the one right above or the one right below? Why that one? There's a reason. I didn't know that reason for a long time. It was these are questions that would come throughout 16 years of dealing with these guys.
Yeah.
These were the questions that would come at me. Why that one? Now, I would give them a price, and part of my job was to, Bank of America gave us, I had $1 billion book, okay? A partner and I, there was 7, 8 traders. A partner and I had $1 billion book that we were managing in semiconductors and biotech, okay? Not the easiest of names to trade, okay? And these guys were coming in, and it was all day, every day, anywhere from 2,500 to 20,000 contracts that they wanted to buy. And they're not going to TD Ameritrade or E-Trade or any one of these places to press a button. They're calling us up and they're saying, I see the screen at $1, $1.10. I want to buy 15,000 at $1.10. And my job was to bring the customers in, collect the commission, but also Bank of America is telling me don't lose money. Yeah. It's like, George Soros wants to buy 15,000 of these, and I don't like them. He wants to buy them for $1.10. I don't want to sell them particularly. I'm not excited to sell them at $1.10. And Bank of America is saying, but he's our customer. I said, okay, so what if I lose, $2 million on this? Lose. You can't lose. It's like, well, what do you want? So you're between a rock and a hard place. So that was the job. It was all day, every day, where these guys are coming in with orders. And when they're coming in and they're specific, you got to take a step back and then I teach what was going on before that 3 minutes, right? It's a 3-minute conversation I'm having with them that they want to do this in a discussion. They probably spent sometimes they spend 30 seconds, but there are times they spend 2 weeks before they come in with that trade, right? So they've got all this, they got the analysis, they got the edge that they're looking for, and they're coming in, and I got 30 seconds to make a decision after a 3-minute discussion. It's hard. That's what makes that game hard.
That's why you created Options Geek.
Yeah, so Options Geek was created to teach people about how the best guys in the world think about the opportunity, right? Because you're going from, the question was, how do you think about going from stock to options? It should be ingrained in you from the beginning. When you're going to press the button to buy or sell a stock, the question you should have in your head is, am I doing the right thing? Should I look at the options? Is this an options idea?
Yeah.
If you're not doing that, you're already at a disadvantage. You're already at a disadvantage. So that is a big part of what I teach, a big part of what I help people understand. The best trade of options for a hedge fund manager is this concept of limited liability, okay? So what does that mean? That means I can buy an option for $1 and I can be completely wrong, 100% wrong, which I am often, 100% wrong, and I'll only lose $1. But if I'm right, in the hedge fund zones, if I'm right, I can make billions of dollars, okay? And that's what they did in the 2008 crisis, okay? The Big Short, you've seen the movie. Great movie, great movie, okay?
Watch it once.
Great movie. It's the greatest trade ever, okay? Why is it the greatest trade ever? Not just because the hedge fund managers made billions of dollars, not just because of that. When you're looking, if I said to you, I'm gonna have a raffle, and I'm gonna raffle off $1 million, and I'm only gonna sell tickets on the sidewalk here, and hopefully I can sell, a lot of tickets, but you're watching me and people are not buying my tickets, and you're saying, all right, well, I'll buy 100 tickets because it gives me a better chance.
Yeah.
And if I only have 1,000 people who bought tickets, you now have a 1 in 10 chance to win $1 million.
Yeah.
And you paid only $1 per ticket, like a lotto.
So that was, I mean,
that's a great trade.
That's the big trade because they were basically betting on something that no one else is betting on.
Not necessarily. They were betting on something that had a high probability of winning.
Of winning, yeah.
And if they won, they were going to make 100 times 200 times their money.
The probability of them winning was so high because everyone else was saying that it wouldn't happen. Basically.
That's right.
Yeah.
Well, really, if you watch the movie, essentially because they were buyers of this the greatest scene I think in the movie was when he went to Las Vegas and he was speaking with the Asian guy, and the guy's like, yeah, I fly helicopters to New York and I got all these guys, and he goes, are you taking the risk? He goes, no, I'm selling it to the big pension funds that are buying hundreds of millions of this stuff and just eating it up. And that's when he was like, oh my gosh. So it's the greatest trade ever because people saw an opportunity to make 100 to 200 times their money. Yeah. Which by itself doesn't mean anything, right? Because you can go to Las Vegas and play, or Atlantic City and play roulette for 35 to 1. So the odds don't mean anything. Yeah. So or a lotto ticket is 200 million to 1. Okay, that doesn't mean anything. What matters is they have 100 to 200 times their money bet on, with a probability of winning that they thought was 85 to 90%. Some of them thought it was certain, right? In the movie, they went to the houses and they said, can you pay your rent? And the guy was like, I haven't paid my rent in 3 months. And they went across, and it's a ghost town, so they went and physically saw the houses where the mortgages were backing a bond. Now, that movie, what people may not know is in the movie you hear the word swaps, and in CDS swaps, and CDS is basically an option. Okay, so they don't really say option, use the term, but CDS is a put option on bonds. Okay, so it was an options. Options provide leverage, limited liability. They were allowed to make John Paulson made a $500 million bet, $250 to $500 million bet, and he made $15 to $25 billion. Yeah. That was the leverage. When you ask me why do people use them, or why does it even exist, it's this limited liability function that embedded in the option that attracts what I call the sharks, the big money investors.
I think I heard a stat one time that most options end up expiring worthless.
Yes. If people are buying puts and calls, stock can only go up or down. So right off the bat, 50% is not going to be in the money. Okay, so right off the bat, 50% will not be. And then of the 50% of calls, say the stock goes up, maybe 50% of that, of all those options across all the different strikes, will be out of the money.
Yeah.
So now you're down to 75% of options. So it's really, to me, it's a meaningless sort of piece of data, because that's just at the end of the option. There's a middle ground between,
I think
what happens.
that stat goes good for people who are writing options.
So even writing options, people like to use that stat to say writing options is the best way to do it.
Yeah.
I'm not here to tell you. Sometimes people say, "Oh, you give writing options a bad name." I said, "I don't." I'm not here to tell you that you can't make money writing options. You can. Okay. I recommend, when people say, "Would you sell options?" I tell people, you know what? The best way to sell options is if you own the stock. So doing a buy right, selling calls, or just selling a cash covered put. Okay, outright. Now it gives you the stock at a certain level. Those two strategies are very conservative to sell options. The best guys in the world, the top hedge fund managers in the world, the guys in New York here, the biggest guys, they are using that limited liability to their advantage. They are buying an option because they think it could explode in value, whether it's on CDS, on bonds, or whether it's on a stock. They're trying to pay $1 to make $3, $4, $5. Remember to get away from just the 10 to 1.
Yeah.
Clearly, it sounds great. Like, oh, if it goes here, you make 10 to 1. And usually that's going to be a great trade in any stock. But, sometimes it's only 2 to 1, or you're making 3 to 1. And the question that you have to ask yourself is that good enough? So I'm going to ingrain in you today that if you went to Atlantic City and I said, I can give you, Patrick, I got something for you. I can make you 35 to, you can make a bet for 35 to 1 odds. 35 to 1 odds I'm going to give you, and you're going to say 35 to 1. That's awesome.
Roulette, baby.
Go right roulette. But now that roulette's not a game you want to play, right? So I want you to start thinking that way. When you think about a stock and an option, and you say, I'm going to buy this option, and wow, I can make 2 times my money, right? $1 turns into 3. I'm going to make 2 to 1. That sounds awesome, right? Because if I buy the stock, I'm only going to make, 10%.
10%, yeah.
Whatever it is. But I can make 200% with that option. The question I'm going to force you to think about is that good enough? Is 2 to 1 good? You just told me 35 to 1 wasn't good enough.
Yeah.
So how come when you're dealing with options or stocks, you don't ask yourself, is 2 to 1 good enough?
Yeah.
That's what I'm trying to get people to ask themselves. Is 3 to 1 good enough? Is 4 to 1 good enough? Is it good enough what the options are? The option is there to offer you leverage. The question is it good enough?
Yeah.
Okay? That's a very important step. So look, you just asked before about calls and puts and give you a quick rundown. So let's for the audience, let's give the quick rundown of what calls and puts are. Okay? And I'm going to preface by saying that the best guys, the top hedge fund managers in the world, okay, most of the time, I'm going to say 90% of the time, are either buying calls or buying puts. Okay? Their process, so the biggest guys in New York, the Soros, their process of figuring out where Apple or Micron, AMD, Snap, Facebook, Google, wherever these things, their process of figuring out where the stock is going, that's complex. Right? That could be that there's an analysis, there's technical analysis, there's data mining, there's a lot going on.
Yeah.
Okay? That process of selection is where the hard work is. When they're looking at options, they try to keep it simple, right? So you have your idea, you get your idea, you decide that this might be an options play, right? So you're doing your analysis on that, and then you have to decide which one you want to choose. They are keeping it simple. So if I'm going to do something, I try to do it like the best in the world. So I'm telling you that the best in the world keep it simple. They buy puts if they think the stock or the market's going lower, or they want the leverage lower, or they're hedging a bigger portfolio with some puts, or they're buying calls either to gain leverage for the same reason, to gain leverage to the upside on a stock, or because they're getting out of position and just want to maintain the risk reward is in their favor to actually just be long calls.
I think it was who was it with Herbalife that he ended up selling all the
Bill Ackman.
Yeah, and then he ended up just just converting everything to options. So either way,
puts.
Yeah, to puts because
so he could sleep at night just in case.
Squeezed out more. Yeah,
that's right.
So I think that's also like a lot of the big guys are using options for hedging against different positions, or if they're
again it goes back to risk reward.
Yeah.
Right. If I can risk this amount, I could sleep at night. Bill Ackman saying, I'm being pressured here because I'm short a lot of stock and I actually could get called in, or it could go against me. It could be a short squeeze, and I don't want to be the guy buying the stock. So I'd like to protect myself. I'm going to buy these put options, and I'm going to have a very similar position, except I'm going to pay the premium up front, and I can't get squeezed.
Yeah.
Right. So that was one of the reasons. But it's risk reward thinking. So. But yeah, so there's several of the reasons why they might do it. All have to do with risk reward. They keep it simple. So I tell everyone, why bother with anything else? These guys, the way they use options, when they use options, is they keep it simple. They buy puts or they buy calls. So what's a call option? In its simplest term, call options, when I tell people call options are risk to the upside, okay? Risk to the upside. So you buy a call option, there's a strike price, okay? And there's an expiration date, okay? And you have many different, so let's call Apple. Apple will have many different strikes, ranging from stocks 235, ranging from 200 to 210, 220, 230, 240, 250. The ones that you should be concentrating on if you're looking at calls is the ones above 235, where the stock is today, okay? And those calls give you the right, so if you bought that option, it gives you the right to buy Apple at whatever the strike is within a certain period of time. At its simplest form, that's a call. Yeah. Okay, so you think Apple's going to go up by the end of the year. So you can buy, say, the first month, January options, 240 options, and they might cost you, $7. Okay? Not cheap. Might even be $8. I don't even know. I haven't looked. But maybe it's $8, $7, $8. The question is that a good buy or is that a not buy again? Is that, we're at that same time. But what it is telling you is that if you pay $7, you have the right to buy Apple at 240 until today. Today until January, the third week in January. Yeah. January 17th. Okay, so is that a good trade or not a good trade? Now, if the stock goes from 235 to 300, you, Patrick, have that right to just pay 240. Okay, that $7 went away day one. You paid $7 at the window, you got your ticket, and it says you can buy Apple at 240. Yeah. Okay, stock goes to 300 because it explodes. Warren Buffett's buying loads and loads more. Everybody loves it. New iPhone, whatever it is, goes to 300. You have your ticket, and it says I can buy it for 240. Yeah. And you know what? It's valuable because it's at 300. The difference is $60. So that option's got to be worth at least $60. Okay, maybe a little bit more, but at least 60. And you paid $7 for it. That's it. So you made a certain amount of money. Now, if it only goes to 270, then it's going to be worth at least $30. Yeah. Okay. If Apple wipes out because China comes back in, tariffs, whatever, Trump tweets, goes to 200 again, well, you have the right to buy Apple at 240. Will you buy it at 240? No. You're going to say, I'm going to go into the market. If I like Apple, I'm going to go into the market. I'm going to pay 200. Yeah. Okay. So that piece of paper is worth zero, nothing, very little, okay? So that, in a nutshell, is calls. Puts are different. Puts allow you to sell a stock at a certain price within a certain date. That certain price is called the strike price for the puts. So puts, downside. Everything to the downside, okay? So Apple, same topic. I think tariffs are gonna hit. I think this whole phase of the iPhone, whatever my reason is, I'm getting data saying the sales in New York, Manhattan are not so good. I think Apple is had its move here, it's gonna go back down to 200. Where are the 220 puts? In December, because I want the earnings, that's it, I don't even need January. In December, the 220 puts, they're only $3. Okay, so I think it's going to 200, $3. Now, I get the right to sell option. But wait a second, I don't own Apple. So how am I going to actually sell it? It's just a piece of paper that you're buying. You don't actually have to own Apple. You're just saying that you're expressing your view that it's going down to 200 and you're going to pay $3 and you're going to sleep well at night because you can only lose the $3. And if Apple goes to 300 because Warren Buffett keeps buying, it's not going to matter because you're going to lose your $3 and that's it. Okay? But if you're right, and Apple sales start slowing, and earnings don't come out well, and China tariffs start picking up, then the stock starts trading lower, then that piece of paper starts increasing in value as the stock goes lower. Okay, so if it goes down to 220, to 215, 210, Apple options, put options, increase in value. It gives you the right to sell, but you don't have the option, you don't have the stock to actually sell, so you can just take that piece of paper and go back to the market and sell that piece of paper to someone else. To someone, it will be valuable.
Yeah.
Okay? And that's what the market is. Okay, so people get confused with puts because they say, how can I sell something I don't own? You own just a piece of paper.
Yeah.
An option, and it says put, and it says
Contract.
220, a contract,
Yeah.
that's it. And that piece of paper is all you own, and if you exercise, and most options are not exercised, most options, when you want to get rid of the option, your trade is done, or you just sell the piece of paper. That option has value.